alleged price fixing by container manufacturers, the bell tolls for fossil fuels, and stalemate in the Strait of Hormuz. Hi, it's Marcus Hand, editor of Seatrade Maritime News here with our May news roundup, Maritime in Minutes, and I'm joined as usual by our correspondent Gary Howard. We'll be discussing the shipping news stories that stood out for us over the last month. May has been a bit more varied in terms of maritime news if the Strait of Hormuz and the conflict in Iran still figure strongly. Gary, can you kick us off by taking us back to the first week in May?
Thanks, Marcus, and hi everyone. I'm starting off with a simple story about shipping cycles I picked out of Norden's first quarter results call at the start of May, where the company laid out strong results from its tanker division, which recorded earnings before interest of $47 million, while its dry bulk segment had a negative EBIT at minus $45 million. One analyst asked the Norden senior management team on the earnings call whether the company should be focusing its resources on tankers, given the stronger market there. And CEO Jan Rinbo said that just a few years ago, Norden's dry bulk division was outperforming its tankers, and the question was asked the other way around, whether the company should be focusing instead on its dry bulk side. Expanding on that simple lesson in cycles, the CEO went on to say that the high asset prices made further investments in tankers much more expensive and therefore more risky. Quote, so the risk-reward, we think, is more skewed towards the dry cargo side. That's also while we're running relatively high coverage on the tanker business. End quote. Norden sees the recent spike in spot rates on the back of the Strait of Hormuz closure as short-term and warned of a longer-term drop of between 15 and 20% in seaborne volumes, which will hit tanker demand. The company has profited from its vessel purchase options for some time now and still has 91 options, of which 33 are in the black, with an average price of 22% below broker values. Instead of just cashing those options in immediately, Norden is weighing the value of operating the vessels in this healthy charter market by exercising charter extensions that they have. Expecting that the asset prices will remain high, the company is also hoping to take two bites of the cherry by profiting from the extension and then profiting again from exercising the purchase option at the end. The company is also considering exercising some of its purchase options and keeping hold of the ships in the fleet. Overall, the company recorded a $1.2 million profit for the first quarter, and ahead of releasing its results, boosted its full-year profit guidance by $40 million in the bottom and top end to give a guidance of $70 to $140 million.
That's a bit of a story of the joys of being a listed company in a cyclical industry. But anyway, I'm going to start out the month with ongoings and happenings in and around the Strait of Hormuz. The US continued its penchant for grandly named military operations with Project Freedom. Announced by President Trump, Project Freedom was designed as a unilateral initiative to reopen the strait and evacuate ships stranded in the Gulf with transits guided by the US Navy.
Project Freedom is underway. Our will is unshakable.
Starting on 4th May, Project Freedom proved to be an ill-planned move and lasted less than 48 hours. Just two US flagships, the car carrier Alliance Fairfax and the tanker CS Anthem, were escorted safely through the strait before the operation was suspended indefinitely. The move angered the Iranians, who responded by claiming control of the strait with a new maritime control area, which included substantial portions of UAE waters from the port of al-Quwain in the west to Fujairah in the east. There were a series of attacks launched, including a drone attack on a refinery in Fujairah, and the container ship CMA CGM San Antonio was struck by missiles while attempting to transit the strait, injuring 8 crew members, some seriously. There was also an explosion on board a Korean-flagged multi-purpose vessel, HMM Namu, anchored OPL at al-Quwain on 4th May. Iran claimed not to have carried out the attack, however, Korean investigations have shown it was most likely an Iranian missile. I talked more in depth about the HMM Namu incident and the general situation in the Strait of Hormuz on Korea's KBS World Radio current affairs program Korea 24 that aired on 22nd May.
To help us unpack the maritime security and geopolitical questions around this incident, we're joined today on the line by Marcus Hand, editor of Seatrade Maritime News in Singapore. But before we get into the wider fallout for shipping in the Strait of Hormuz, let's start with the central question investigators are trying to answer: who may have been responsible. South Korea has gone as far to say that the probability of an attack by an entity other than Iran is pretty low, but it has yet to pinpoint a culprit. Mr. Hand, you are a maritime journalist with over 20 years of experience working in the field. Who do you think was behind the explosion aboard the ship, and how did you come to that conclusion?
Well, I think when you look at this, the most likely culprit in this case is going to be Iran. And that is simply because if you look at what's been happening since the conflict started on the 28th of February, almost from day one of this war in the region, Iran has targeted commercial shipping. By targeting commercial shipping in and around the Strait of Hormuz, it's gaining a sort of leverage and military advantage. There'll be a link to that program and the stories mentioned in the show notes. If you're enjoying the Seatrade Maritime podcast, make sure you never miss an episode by subscribing on the app of your choice.
Thanks, Marcus. I'll take us into week 2. I'm picking up a story by Nick Savides from the 14th of May, which took a look at the longer view of shipping demand explored in Danish Ship Finance's latest maritime report. In a nutshell, the report noted the Strait of Hormuz closure as supportive of renewable energy as nations focus on energy security, leading to lower volumes of energy products being moved by sea. The report essentially warned that shipping could be creating a future headache by basing its demand assumptions and vessel pricing across containers, gas and tankers on a demand trajectory established over the past 20 years. Quote, "If the premise is wrong, the prices fall structurally, not cyclically," wrote DSF head of Sustainability and Research, Christopher Rex. Quote, "Asking now whether the fleet has been sized to a demand reality that still exists costs caution on new commitments. Asking later costs capital that has already been committed." Nick writes that the DSF report builds on Kuhn Foundation report released 2 years ago, which asked similar questions on demand fundamentals, but obviously didn't have the recent Gulf situation spurring the energy transition by hiking energy prices, felt particularly keenly in Asia. Both reports conclude that tankers and LNG carriers are in massive oversupply if the world aligns with a 1.5 degree trajectory by 2050. Adding my own colour there, the world is clearly not on a 1.5 degree trajectory, so that may soften the blow slightly. Changes in China over the past 5 years have helped to shape the dry bulk markets, but its evolution from an importer to a gatekeeper of green technology will further affect shipping, DSF said. Policy in Beijing will displace seaborne LNG volumes with pipelines, crude will be hit by ongoing EV investments and growth there, and renewable power generation will displace coal and overall dependence on energy imports. Sky-high charter rates, which have tripled since April to more than $143,000 a day, are not indicative of the earnings potential, said DSF. There's a lot more depth in Nick's story, which is well worth a read. Have a click through the show notes once you've finished listening to the podcast.
It's interesting what people think is going to happen as a result of the closure of Strait of Hormuz, because I've read the absolute opposite as well, where people say it underscores how dependent we are on fossil fuels for the next 20, 30 years. So yeah, it's interesting to see the two schools of thought.
Yeah, absolutely.
Right, I'm going to be coming back to the Strait of Hormuz again, and that's with a prediction story from our correspondent Paul Bartlett on 12th May. And quite a bit of that already seems to be coming true. The story was headlined, "Probability of a stalemate in the Strait shoots up." In the story, analysts said that the probability of 20 ship transits a day by the end of May had fallen to about 50%, with the odds of an unrestricted shipping agreement falling to just 10%. At the time of recording, unrestricted shipping of the Strait of Hormuz was certainly not happening, and transits remain a small number of ad hoc crossings, although the exact number is actually hard to determine with vessels switching off their AIS transponders in many cases. Analyst Poten mapped various reopening scenarios, including a clean reopening, a nervous reopening, and a false dawn where the strait reopens and a vessel is subsequently attacked or hits a mine. We've actually really already seen that one actually happen. As it stands, the stalemate does continue, with mixed signal on progress of negotiations between the US and Iran, and the likelihood of agreeing some kind of peace accord. And despite a supposed ceasefire, sporadic attacks remain on commercial shipping by Iran and on Iranian targets by the US. I will also just make a quick mention of a podcast episode I recorded with Vivian Miranda from BCD Travel, and that was on the impact on crew travel as a result of the conflict, which extends well beyond the Middle East in terms of that actual impact. Again, just a few weeks later, Vivian was saying today on LinkedIn that some of what was predicted in that episode was already starting to happen just a few weeks later.
Yeah, potent mentioning the various reopening scenarios there. And I think it was just last week we had the publication of some guidance from a lot of the shipping associations about how to deal with that reopening and the sort of chaos that might ensue and the potential safety implications, which is worth searching out on the site as well. But I will take us into week 3. I'm pretty sure I've covered this on Maritime in Minutes before. And after writing another story on it yesterday, I can confirm that Diana Shipping and Genco Shipping and Trading are still up to it. On the 19th of May, I wrote about the slightly odd situation where Diana Shipping sold some of its Genco shares in order to fund its acquisition of Genco. Those with a better understanding of corporate finance and stock markets, feel free to shout at me through your podcast listening device of choice. But it seems that this was a move, at least in part, for Diana to put its money where its mouth is and back up repeated assertions that Genco shares are overvalued due to this ongoing acquisition attempt. Genco sold around 108,000 shares, according to an SEC filing, which noted that the proceeds are intended to be used to fund its acquisition of Genco, along with the committed finance agreements that it has in place for that purpose. So the offer on the table from Diana Shipping was $23.50 per Genco share at the time. The stock market's most recent close was then $24.42, continuing a downward trajectory since a high of $27.08 on the 12th of May. I had a quick look this morning, 28th of May, it has shares at $23.32. Genco, of course, seized on the disposal, saying that Diana had shown its hand and the sale underscored Diana's lack of commitment to creating value for Genco shareholders. Diana Shipping said it was prudent to realise a profit on its investment in Genco at what it called an inflated share price. This sort of back and forth has intensified in recent months, but has been ongoing since Diana's first unsolicited offer in November last year. There is a ray of hope for some peace, however, a conclusion potentially on the 18th of June at Genco's annual meeting, where both Diana and Genco have put forward a slate of board nominees for election. That story that I mentioned writing yesterday explains some of my word choices when describing the stock prices just then. Diana has now upped its offer for Genco shares to $24.80 after months of defending its $23.50 offer. It said the new offer represents Genco's net asset value at a time of cyclically high asset values. I do seem to recall it being sort of shipping 101 that you buy at the cyclically high asset values. I think that's how you end up with the biggest profit. One quick last note, though, from my May 19th article and something Marcus and I were chatting about yesterday. So I find something weirdly childish in companies creating websites to promote their viewpoint in a corporate dispute. The cashforgenco.com and gencodrivesuperiorreturns.com URLs sort of feel to me, if I show my age, like a sort of teenage dispute on MySpace with a dash of Trumpian flair to make it feel a bit more 2026.
You are probably the only person to have described a potential shipping transaction as like a MySpace dispute in 2026. On that note, I'll move on to my pick for week 3, and I'm looking at a story that has considerable interest in Singapore, where I'm based, and that's because it involves the chairman of the largest local ship owner. The story involves the US Department of Justice and price fixing by container manufacturers in 2021 and 2022 during the pandemic. An indictment covered 4 of the world's top container manufacturers, Singamas, CIMC, Dongfang International Containers, and CIXC Containers, and 7 executives from these companies. The indictment was released following the arrest of one executive, Vic Nam Hing Ma, also known as Vic Ma, the marketing director of Singamas Container Holdings. However, it's another name that caught the media attention in Singapore, and that was SS Teo, chairman and CEO of Hong Kong-listed Singamas and chairman of container carrier Pacific International Lines. The indictment alleges the companies and executives colluded to roughly double the price of shipping containers, with details of communications via a WeChat group on limiting the number of production shifts and hours, and installing cameras on production lines to ensure agreed limits were not exceeded by the companies. The charges carry a maximum penalty of 10 years in prison and a $1 million criminal fine for individuals and a maximum penalty of $100 million fine for corporations. Meanwhile, SSTO, who's a prominent local businessman here, has taken a leave of absence from his role as chairman of PIL, as well as chairman of the Singapore Business Federation, and roles with the Singapore Economic Resilience Task Force and trade agency Enterprise Singapore, as he deals with the allegations.
And the last one from me, Frontline and CMB Tech, owner of Euronav, had their quarterly earnings releases within a few days of each other. So I tuned into the calls and dug through the presentations for a bit of a compare and contrast. The slides and commentary helped explain how crude tanker markets had managed to maintain rates and sort of find their new balance despite a large chunk of crude oil exports being removed from the market by the closure of Hormuz. The exact figures used by each company varied, but they both published these charts showing the loss of crude volumes of, I think it was 15 million or 17.7 million barrels per day on the left, and the various market factors clawing back some of that volume on the right, including pipelines taking crude to other export destinations, such as Saudi Arabia's Yanbu pipeline. They brought back around 5.5 million barrels. There was an average of around 1.2 million barrels that flowed through Hormuz in March and April. Floating storage releases and the easing of Russian sanctions added back about 700,000 barrels a day. And then, quote, then the real interesting part comes, and that's on one hand the export growth out of the US, which is a combination of additional volumes but also strategic petroleum reserve releases, roughly 1.4 million barrels per day, and then also other countries stepping up the game, for example, Brazil, Guyana, Canada, Angola, and they are additionally bringing 1 million barrels per day capacity to the market, was said during CMB Tech's first quarter earnings call. That still leaves a gap of around 5.3 million barrels a day, according to CMB's figures, but that difference is sort of largely bridged in ton-mile terms by longer voyages to China from the new exporters compared to their previous suppliers in the Middle East. Frontline CEO Lars Barstad said the single largest factor affecting the market, from his point of view, is the amount of VLCCs staying off the market due to non-economical reasons, those stuck in the Gulf and those that are waiting outside. He theorised that owners that are most likely national oil companies, with VLCs just sitting on standby outside the Gulf, are positioning themselves to be the first into the Gulf when Hormuz is opened again, giving them access to oil at a massive discount. And those vessels are likely on time charter contracts agreed years ago rather than at the current market levels, making the price of that strategy, that gamble, a bit more manageable. It's his speculation. Quote, the alternative is that if they want to compete with us, say in the Atlantic market, that vessel will be gone for 70 to 90 days. Then they really have to call us if they need freight out of the Middle East Gulf quickly, he said. The companies are taking quite different approaches to the high market we're seeing in crude tankers. CMB Tech sold off 8 VLCCs and a Suezmax so far this year to book some significant capital gains. And at the time of the quarterly report, it had just 4 VLCCs on the water and 2 new builds, plus its 18 Suezmaxes in operation. And then I've gone a bit long on this one, but just there was a little snippet from Barstad that sort of supports the earlier story from Nick Savides. Quote, I think the point that we cannot get away from is that this whole situation, which has now lasted for 12 weeks and counting, it's also a huge push for energy diversification by way of looking at other kinds of energy sources like nuclear, wind, and solar. It's actually a push towards long-term energy transition. But I think that's 5 years out, he said.
Right, and I'm going to close out, May, with a story on container shipping. As a general rule of thumb, the lower the quality of service, the less you pay. This equation doesn't work in container shipping, though. And Nick Savides explored how schedule reliability is actually inversely related to freight levels in the sector. During the height of the COVID pandemic in mid-2021, spot rates peaked at over $7,000 per FEU, and long-term rates, more than 3 months, at over $6,000 per FEU, while reliability meanwhile cratered to just 20%. Similar effects, if not quite so stark, more recently include the El Niño-inspired Panama Canal drought in 2023 and the Red Sea crisis, which began in late 2023, and then the more wider Middle East crisis we see today. The pattern is repeating itself again, as Asia-Europe freight rates are on the rise, as Hamburg experiences an increase in congestion due to a pilot strike, while both Rotterdam and Antwerp have seen lower water levels, and that is also driving up congestion. The more ships and cargo get delayed, the tighter capacity becomes, and the further freight rates rise. Analyst Sonetta commented, "Container shipping is arguably the only industry where higher prices correlate with worse customer service." And on that somewhat topsy-turvy note, that is all we have time for on this episode of Maritime in Minutes. Links to all the stories discussed are in the show notes. Thank you for listening, and we look forward to joining you on the next episode of the Seatrade Maritime News Podcast.